closest to the screen, closest to me, is Simon Milne, who's a member of the FTA. He's the Treasurer of Australia Pacific Airports, once upon a time known as Melbourne Airports Corporation. He's been Treasurer there since June 2013, but he's been a very busy man in that time, as we're about to hear, including a $1.1 billion syndicated bank facility. And Simon's previous career was with Crown Limited and prior to that Transurban, so very experienced corporate treasurer and essentially representing one of the biggest issuers in our market today. Sitting on the other side in the white shirt is Martin Ryan. Now Martin's comes from the boutique fund manager Mutual Limited, which has got about $1.8 billion funds under management. But Martin's been a sort of key driver of the fixed income market here in Melbourne for nearly 40 years, and previously sort of investment director for ANZ McCorn, and then the managing director of Austock, and most recently now the founder of Mutual Limited. So I think it's interesting to get the perspective of someone who's assessing these deals as day to day as they come in. And then really the other side of the scale is, in terms of scale, is Australian Super, and Daniel Berger's an investment manager for Australian Super. So I'm very interested to hear how the big industry super funds, but the big super funds, how they're looking at fixed income at the moment. But we'll open things up to Simon first, and if I can find my cleverly drafted question. I reckon you've probably, from what I can hear, been the most active as an Australia Pacific Airports of all the issuers across the markets over the last couple of years. I think you've got over $2 billion in issuance in total, and I'd just like you to sort of give the audience an insight into the funding task of APA and how you go about it, and how you've sort of received the presentations today.
Sure. Look, to start off, I'll put everything into context. Melbourne Airport, which is owned by Australian Pacific Airports, currently has $2.4 billion in debt outstanding. Total debt available to it of 3.5. We've got debt in the Aussie market of 500 million, 300 million wrapped. If those of us who've been around long enough remember that you couldn't do anything north of 5 years or 7 years in the Aussie market without having an infamous MBAA or FSA wrap, and we unfortunately or rightly have those still outstanding. We've got 790 million in the US PP market, and we've got 785 million outstanding in the Euro market. And as pointed out, we recently just completed a $1.1 billion syndicated facility that was self-arranged with a group of 11 banks. Melbourne Airport, sitting here today, we've got a funding requirement of $10 billion over the next 20 years. For those of you who are regular users of the airport, we'll be going, thank God. We are moving from 30 million passengers to 60 million over that time. So that sort of puts it into context. To put that in context of other airports, Sydney Airport has around 38 million passengers per year. Heathrow has north of 60 million. Our friends up in Hong Kong have about 64 million. If you bring that back down to another level, when Hong Kong Airport was built, its capacity was 70 million. They're hitting that capacity now. We're hitting our capacity at 30 million, hence the expansion program that we're doing. Over the next 4 years, including refinancing, we're doing around 2.5 billion in capital raisings. So if you sort of, on average, we'll be going to the market between $500, $600, $700 million per annum. So we'll be, as described the other day, we will be a serial issuer into the market. Now, whether that market is the US private placement market, the Aussie MTN market, or up into Europe, that remains to be seen.
Excellent. Now I'll open it up to Martin, because interestingly, significant deal in the local markets we heard from Brad Scott today is Perth Airports, and I know that you actually offered a placement with Perth Airports overnight, Martin. Are you able to talk to us a little bit about the thought process? You don't necessarily need to share the decision.
Certainly. We've got sort of split hats. The majority of the funds that we manage are for insurance companies, and so typically they have a government, semi-government bias with the add-on of the corporate side. The other part of our business is sort of family or high net worth individuals, and they certainly like the credit risk. I guess the bit that we enjoy about the domestic corporate market is its transparency and speed to transaction, and that we found out about this deal yesterday morning when I was on the phone just before I came here at 10 o'clock. I was speaking to our desk, and the volume of bids was being upgraded, the margin above swap was narrowing, and you're getting that as sort of online information, and the deal will be transacted this afternoon. So from our point of view, being able to go to high net worth individuals and say that we can let you know on Monday what a deal looks like, and on the next day have it transacted, is extremely important. For our insurance company clients, it's all about spread. So at the moment, we're not investing heavily in corporates because the corporate spreads have come in so far. We prefer to be sitting in government and wait for the spreads to go out. That's our investment management decision, rightly or wrongly, and so we're well on that. But the other side of things is that we're finding our private clients are hurting in that they're running in 3.5% in term deposits now instead of 4.5 and 5. So they really are looking for that pickup, and so when the banks come with BBB rated at 205 or 210 basis points over swap, then you find that the high net worths are in there for $5 and $10 million leagues.
And I confess to Daniel, I'm not entirely sure about how Aussie Super goes about managing fixed income these days. It's an interesting one for the industry super funds where you're actually bringing expertise back in-house. There's traditionally been a model for outsourcing and mandating external managers and maybe making an asset allocation decision internally. Of course, fixed income tends to fall into the cash bucket as well for a lot of funds. So I'm very interested in how you treat this asset class.
Yep, thanks, David. So I'll just give you a quick snapshot of Australian Super. So total assets are $75 billion. Probably our distinguishing feature is our growth. We expect to grow about 10 to 20% per annum, so sort of double every 5 years, a combination of cash flow and mergers, and that's certainly happened in recent history. Of the $75 billion, we've got $9 billion in fixed income, and that's pure fixed income excluding cash, and there's about 40% in Australia, 60% in Australia and about 40% offshore. A couple of other sort of defining features of Australian Super. One, we've got a very young membership base. The average age is in sort of mid to high 20s. 90% plus is accumulation, and we're 100% defined contribution. So to answer your question, David, about how we think about fixed income, so we internally in fixed income have a team of 5, and really what we focus on is the sector allocations. So we look at what our split should be, Australia versus international, government versus credit, and then within credit markets, which parts of the market we like. And then the actual implementation gets outsourced to a fund manager. And we sort of do that in 2 different ways. One, we have diversified mandates, which is sort of your traditional fixed income, sort of Martin was touching on the cover, government, semi-government, and corporate sort of investment grade bonds. And then we'll also set up sort of bespoke portfolios. So a good example, we've got an arrangement with Challenger where they invest in real estate loans and leveraged buyout loans. And so in that process, we develop a thesis that we think there was an attractive opportunity in those sectors, and then we get Challenger to do the implementation because they've got the resourcing in the team. But to touch on your other point, David, about internal management, so Australian Super in the last 12 months has insourced Australian equities. We've got an Australian equities capability, also unlisted infrastructure and property. Inevitably, that will extend over to credit, and I think the other bit we will have capacity to do is tap into those equity teams combined with the credit to provide financing against infrastructure, real estate and corporate assets as well.
So bring it back to Simon. Simon, do you have any interaction at the moment with domestically based managers? I mean, there's one issue in terms of road showing and actually meeting people in the first instance, but in terms of ongoing relationship, how's that managed by APA?
Look, it's part of my role, yeah, the title is Treasurer, but I think what a lot of people have to realise, one of the biggest roles as a Treasurer is actually stakeholder management. Be that your banks, your rating agencies, those of us with public issues, it's dealing with the investors. We make ourselves available through our debt investor website for continuous disclosure. We're publicly owned, but we're publicly unlisted, if that makes sense. So whilst we put out an annual report, we disclose our accounts, we're not listed on the stock exchange. So we've got a different disclosure requirement to, say, a Toll or an Orica or a BHP. But that said, we make sure our debt investors are across the information that we're providing to our shareholders. I've just recently been up in Asia doing a non-deal roadshow, giving investors an update in Singapore, Hong Kong and also in Tokyo. I was in the US early in the year meeting with US private placement investors. We're about to do a domestic bondholder update in the coming weeks. So yes, we make ourselves available either through an organised forum or ad hoc basis.
A question to Martin. You joined this association partly because you wish to reach out to the corporate treasury community. And you and I have had a few discussions about how the broader marketplace perhaps doesn't understand fixed income as well as it might. What would you suggest needs to change, or do you feel that the changes are now taking place?
David, I guess I'm coming with two hats on in that prior to Mutual, when I was at the Ausstock Group, I did do sort of capital raisings for smaller corporates for about 10 years. And my experience then, and it could be very different or it could be limited to sort of the top 50 companies, is that most of the corporates didn't understand the opportunities between fixing and floating their facilities, or if they did, it was very much driven by their bank, with one view only being given at the time. The other one was that we used to do a lot of capital raisings on an unsecured basis for these smaller companies, and that was quite successful for them in terms of being able to give them better terms to negotiate with their banks if they wanted to. And in fact, for one company, we raised all of his debt such that when the bank came to review him annually, at one period he said, well, I'm actually going to review you because I don't have any debt from you, but I've got term deposits with you, so I'm going to review my bank. So I think that there is a lack of understanding of the instruments that can be used, as I say, probably outside the top 50 companies. We act for companies investing their money short term. We get better rates than they do with their own single bank, and certainly we found an opportunity to talk, perhaps particularly in the property sector, where fixed to floating is such an important element, that there can be fine-tuning in there. I've experienced that people don't use 3-year bond futures, which is a very efficient way of fixing and non-fixing your debt. So, yeah, there are opportunities.
Thank you. And a question for Daniel, perhaps closing the circle on an earlier discussion. Natalie Vanstone made a really interesting point about the opportunities for reverse inquiry, and the opportunities mentioned were sort of if a company in a particular industry is issued into a particular market, then you're likely to get investors from that market coming back and perhaps making inquiries as well. I'm going to actually ask this question to later in a different form to Simon. Broadly speaking, to what degree is the flow of deals, is it the banks coming to you with deals, or is Aussie Super now reaching out for yield pickup and diversification?
Yeah, look, currently, given we do very limited things internally, our deal flow comes from banks or other advisors, arrangers, but certainly when I look forward, particularly now that we've got an internal equities capability that will manage, probably up to $10 billion over the next few years, they will have a lot of contact with a lot of corporates. And I think once we are in a position to start lending directly, that word will get out and we will want to engage directly with corporates. We also, through the unlisted teams, our infrastructure people have relationships with borrowers, and I mean, not to upset anyone in the room, but the closer we can get and cut out the intermediaries, the better I think it is for everyone.
I might add, the intermediaries have a very important function to play, given that they're sponsoring this event. We'll thank them all by name in a moment. I might conclude with a double banger question to Simon. Firstly, just that how you might have experienced reverse inquiry. Are you considering going to Asia? It's actually a triple banger question. There's a reference to cross-currency swaps before, and you gave me an excellent sort of insight into your experiences with IFRS 13 fair valuation standards. So if you can cover all that off, please do.
How much time do we have?
I'll give you 5.
Good. I'll give it to you in 2. Look, firstly, reverse inquiry. Look, it's fair to say given our credit quality at A-, we do receive a lot of reverse inquiry, be it out of the USPP market, be it out of Europe, be it out of Asia. Nothing out of Australia. It's the way it is, and it's one of the things I haven't even had an opportunity to talk about Australian investors' lack of ability going to 10 years. We'll talk about that on another day. But with my attitude to reverse inquiry is, what are you actually giving up? Yes, it's great to get a $50 million, $75 million, $125 million reverse inquiry, but what are you benchmarking that pricing against? Are you giving up other liquidity out there in the market? In the case of a USPP investor, are you actually giving that investor increased leverage over you by going outside of the broader investor group? For me to accept a reverse inquiry, it would want to be a very bespoke piece of fundraising. I would have no problem in doing 3 or 4 inquiries pulled together, probably out of Asia, for example. But to sort of do one, you want to be very bespoke and really suit my purposes. In terms of Asia, look, every market that I look at, and when I stand in front of the board making a market recommendation, I'm benchmarking that against 2 or 3 other markets at any point in time. And that includes the Asian base as well. If your question is based around, would I do Asia as part of an EMTN or part of the US process? Yes, if the question is, would I do a Jap Yen deal or a Malaysian Ringgit deal or a Thai Baht deal if it was open? The answer is no. In terms of the currency exposure, well, given the changes in accounting standards and the corporates now having to do what banks do in terms of doing a credit spread based on our counterparties, it does change the dynamics in the way we look at our swaps. Yes, we can be hedge effective from a transaction perspective in terms of having your hedge equaling your underlying debt, but lovely accounting friends who seem to know everything and know nothing want us to put a credit default onto our swap counterparties, which therefore impacts your hedge effectiveness. Now, the beauty of that is none of the 4 accounting firms can agree in which way to actually calculate that. Do you use a treasury system that hasn't been updated to take into account CVA? And I don't believe any of them have been. Or do you use Bloomberg, or do you use Reuters to do a simulation? But I'll end it there, otherwise I'll go to 3 o'clock.
And FTA's thoughts on the matter were actually submitted to the International Valuation Standards Council recently, which is developing valuation standards for derivatives as we speak. Doesn't have the same sort of imprimatur that the International Accounting Standards Board does presently, but it's chaired by the guy who led the IASB previously, Dr. David Tweedy, so we think it will over time. So anyway, it's important for anyone who's looking to borrow offshore cross-currency swaps, etc.